Hey everybody, I'm Tarl Yarber. Welcome to another episode of Fixated on Real Estate Experts Live. Today's show is kind of a heavy topic, and it's one of my favorite topics, which is speculating what's going to happen in the future of real estate. But it's more of like a true educated speculation with facts, figures, data that's going to be provided to you guys more on the lines of what's going on with foreclosures, forbearances, policy changes into the future going into 2021. There's a lot of speculation that we're going to have a real estate crash in 2021 of some sort. Now, the challenge with saying real estate crash is there's so much to real estate that's out there. There's single family, there's multifamily, there's commercial, there's industrial, there's all the niches with builds, land, and so forth. And to say that real estate is going to crash is kind of a hard topic to even really discuss. What we're going to go into today is more specifically what's going on with the single family market and what's happening with those forbearances, potential foreclosures nationwide with lockdowns and also with just COVID in general with what's been going on with that. And is that going to impact 2021? And how will that impact you as an investor? What will that do for you as an investor if the market shifts in some way? But what if it doesn't? What if the market doesn't shift? What if we overcome this challenge in the single family market and all of a sudden there is no huge major mass supply that's out there and the market continues to just crash at nowhere? No, what if it actually normalizes? Or what if the market keeps going up? What will you do in your business? What will you look back on and wish that you did? So listen to today's episode and our experts. We got Fettke back with us again. We love her so much. This is definitely her cup of tea to help you analyze markets and also decide what you should be doing today. She has a great track record of success being able to help investors navigate times like today, even pre-2008. Rick Sharga, who's one of the most prolific experts on the foreclosures and forbearances out there in the United States. He's back again, and we love having him on the show because he's going to give us actual data we can use with numbers and figures that we can actually make bets on in our investment career. So think through this today. It's a heavy topic. How can you use this for your real estate career going into 2021? How can you use this today and how can you adjust? Because we go in a lot of policy changes. We go in a lot of challenges with forbearances, what might happen with foreclosures, and what that means for other investors like yourself. So stay tuned and let's check it out. What's up, everybody? I'm Tarl Yarber with Fixated Real Estate. Welcome to another episode of Fixated on Real Estate Experts Live. We are blessed to have returning guests, Rick Sharga and the beautiful and always talented Miss Fettke, or Mrs. Fettke, who the only reason why we're friends with is so we can be friends with her husband, Rich Fettke, who has joined us before in the show previously. And if you want to know all about how much we love Rich, go watch that episode that we did with Rich on business scaling a few months ago. That said, today's topic is a heavy topic. And we're going to go really deep into it today. This is something that is a lot of people are like waiting in real estate. It seems like there's a lot of money on the sidelines right now. There's a lot of concerns for the future of real estate. There's a lot of questions of whether or not we should be investing today or holding off for some big thing later. Because some of us got into this market back in 2005, like me, 2006. Kathy, when did you get into the market?
97,
right? And some of us have seen these crashes before. And we might be a little fearful that there's another crash coming and what that might look like in the single family real estate market. We'll also talk about multifamily and commercial and even industrial a little bit about that today. And, what should we be doing? Should we be waiting for this crash? What's all the forbearances actually going to bring to the market? And there's a lot of forbearances, and we'll get into that momentarily. Will that bring more foreclosures? What kind of policy changes are coming down the pipeline? What does that mean if Fannie and Freddie even go private or not? Like, well, I don't know. Right? Let's go into that, right? We'll dive into so much today, and I hope that this will give you guys some perspective and some confidence into your future real estate investing so you can make some strong decisions. That said, let's dive into introducing our guests. First and foremost, as you all know, the wife of Rich Fettke, the world famous athlete, she is the co-CEO of Real Wealth Network. Kathy is a best-selling author of Retire Rich with Rentals. She is an active real estate investor, licensed real estate agent, and former mortgage broker specializing in helping people build multi-million-dollar real estate portfolios that generate passive monthly cash flow for life. With a passion for researching real estate market cycles, Kathy is a frequent guest on CNN, CNBC, Fox, Bloomberg, all the great channels. You guys have about 50-something thousand members in Real Wealth as well.
Yeah, 53,000.
Yep, and you guys help people find homes nationwide to build out passive income for their portfolios and so forth. You guys do a lot of great work with that. Awesome site. Check out realwealthnetwork.com, or actually, we're realwealth.com.
Realwealthnetwork.com is still the better site for that.
All right, check that one out. Yep. So Rick Sharga, who we've had before, is the, I almost read your old bio, forgive me. He's the executive vice president of Realty Track. if you guys haven't checked out Realty Track, it is definitely going to be a great site. It is a great site today, and it might be a very helpful site here soon in the future, even more so for you real estate investors. A leading foreclosure search and discovery website used by real estate agents and investors, an accomplished executive with over 25 years of experience. Rick was formerly an executive vice president with Carrington Mortgage Holdings and chief marketing officer for the company's Vila business unit. What's the Vila business?
It's actually Villa. It's the real estate and title company.
There you go. That one. Rick was also the chief marketing officer for 10X, which is also was the owner of auction.com. And he was also 2013 as EVP of company's auction.com business unit. He is a leading expert on foreclosures and also now forbearances. And he is frequently quoted and interviewed on CNBC, CBS, Evening News, NBC, all the great channels that we all love and hold dearly. Thank you, Kathy and Rick, for joining us once again for the show. And this is going to be a fun one. And I've been looking forward to this one. Now, I know why you are all here today. You guys are all questioning why Jay Scott is not with us, our perpetual guest. Jay Scott is on an aeroplane flying high to a undisclosed location, and he is not able to join us today on this particular topic. But I do know what he's going to ask, and I do know what he'll contribute, so we will jump into that. So, that said, let's jump into this. Guys, 2021. We've seen a lot of videos on YouTube. There's a lot of speculation out there right now with what's happening in 2021. I just want to get a quick update from you, Rick. You have some of the stats better than most of us. I want to bring up forbearances and what's been going on with forbearances. There might be some misunderstandings with what's been going on with forbearances, what's happening today with forbearances. And it's better, instead of just speculating, let's just talk some numbers and what's actually out there. So can you give us a rough idea about how many forbearances are out there? And if you guys, and also explain what a forbearance is briefly and why it's so unique today.
Yeah, we have more than 3 hours for this. Just kidding. So the forbearance program this time is a little different than what we've seen in the past. Forbearance essentially is basically a lender giving a borrower a free pass for a certain period of time on making their payments. And the forbearance idea has been around in the mortgage industry forever. It's different this time for two reasons. One, historically, if you had a forbearance program, when the forbearance period was over, you were required to make a lump sum payment of all the payments that you'd missed, which didn't make it a terribly useful program for most borrowers, because the only reason they needed to miss payments is because they were in financial distress. The other reason this one's a little different is because it's related to the pandemic, and it was pretty much ordered by the federal government on any government-backed loans. So for the 2/3 of the market that is backed by Fannie Mae, Freddie Mac, FHA, USDA, VA, all of those loans, there is an initial period of 180 days where if a borrower stipulates that their income has been impacted by COVID, they're allowed to forbear their payments. And then there's a second 180-day optional period at the end of that. And the program started back in March when the pandemic was declared. And at the peak of the program, about 8% of borrowers were in forbearance. That worked out to about 4.4 million people that were in the forbearance program. What's been interesting to me is there's a couple things that are interesting to me about this. The knee-jerk reaction when the program was announced was that a calamity was about to ensue, and we were going to see another housing market crash. In fact, there was an economist on the East Coast, whose name I won't mention because I don't want to give him any pub, who said that 25 to 35% of borrowers were going to wind up in forbearance. And we, as I mentioned, we peaked at 8%. When people saw 4 million people in forbearance, though, they started to believe that meant 4 million people were going to wind up in foreclosure. Mm-hmm. These were all distressed borrowers, and it was going to be a problem. The fact of the matter is that the number of people in the program has dropped every week since the program peaked back in late March. And I would submit that if we were really looking at a housing crisis, we would have had a peak at the end of April, at the end of May, at the end of June, the end of July, and so forth. Every time we were getting to the end of the month when the next month's mortgage payment would be due. But in fact, we've been dropping down consecutively, and we're now around 2.4, 2.5 million people that are still in forbearance. 80% of them are there that have been extended into the subsequent periods, which is how the program was supposed to work. And that means fewer and fewer new people are actually entering forbearance. So it's a good thing. And the one other point I want to make for you, and then I'll shut up for a while, is that 87% of the people who are exiting forbearance are doing so successfully. And by that, I mean, they're in some cases, they've never actually stopped making their payments, even though they didn't have to make the payments. So those people are exiting, they continue to make their payments. About 20% are just having their loans reinstated. There's loan modification programs. In some cases, loans are being paid off. But if you go back to June, when people first started rolling out of forbearance and go through November, according to the Mortgage Bankers Association, less than 13% of the people in the program have exited without some sort of plan in place to successfully get back into on-time payments. So realistically, you're looking at somewhere between, I'm going to guess, somewhere between 10 and 15% of the people who have been in forbearance who are potential default candidates when all is said and done.
So you're saying that there was only ever no more than 4 million households in forbearance?
At the peak of the program, 4.4 million. Yep.
And that's like all single family type of across, like whether it's a conforming loan or non-conforming or any of that kind of stuff, or is it just all?
Yeah, that's
FHA,
so
Fannie-Freddie?
it varies by group. So if you look at the way it's broken out, they have Ginnie Mae portfolio loans. Those are primarily FHA and VA. They're running at about 7 to 8% of their loans being in forbearance. Private portfolio loans are running similar numbers, and those would be the non-QM loans from last year, maybe some jumbos. And then the conventional loans, Fannie and Freddie numbers have been going down every week. So they're down around 3.5% of their loans in forbearance. But yeah, we peaked at 8%, which is again about 4 million borrowers. We're down now to around a little over 5% of loans overall are in forbearance, which again takes you down to about 2.5 million. And the bulk of those people are due to exit by the end of March 2021, assuming the program isn't extended.
And so I heard you just also, you kind of dropped that saying that most of these, it sounds like most of these are FHA people that fit in FHA. You said like 8% of Ginnie is forbearance wise. So that's mostly FHA. If the rest
it's
of those,
mostly, and if you look at the seriously delinquent loan stats that are published, FHA seriously delinquent loans are running at about twice the rate of any other type of loan. So if you are looking for an area in the housing market that's probably vulnerable right now, it's the FHA loan pool. If other borrowers, if they run into trouble next year financially, probably have enough equity in their homes that they'll be able to sell them in a traditional sale. But your FHA borrower typically is lower income and typically has a low down payment loan, maybe 3.5%, 4 or 5%. They might not have the equity cushion to be able to get through this crisis. And so that would be an area that I'd be looking at as a potential weak spot in the housing market.
well, it's one of those deeper topics that I don't think we're going to get into too hardcore today, but the demographic that is being affected the greatest due to COVID and all these challenges and policies has been the people in the lower income category, and FHA and so forth I mean, from hearing what you're saying, FHA is one of the more heavier hit areas, which typically is the lower down payments, the lower income, the more financially challenged demographic.
And you do have a lot of minority borrowers in those categories as well. So you're absolutely right. It's it's going to be a tough road for a lot of those borrowers as we get into 2021, unless the economy comes back and the rest of these missing jobs reappear.
So Kathy, like when that comes to, so we're talking more of a general holistic aspect of real estate here and people in forbearances and the potential for foreclosures, which we're going to talk about more here soon. You help represent a lot of real estate investors and people investing more on the landlord side. What are you seeing and hearing right now from your clientele out there as far as when it comes to landlords going through the situations? And are they getting forbearances? Are they struggling with, and we can even start bringing up the eviction moratoriums and so forth right now and how that might be affecting landlords in single and multifamily as well. What are you seeing in the world with your 50,000 members and households?
Well, we did a survey a few months ago and got some really great feedback. There was I think 40%, it was 35 to 40% of the people who responded to the survey. And I think it was 400 people responded out of the 53,000. So not everybody likes those surveys, but at least from that group, what we discovered is there was, again, like a 30% of that number who was struggling. And when we dove in a little bit deeper, it was mainly people who were self-managing in California. They had not purchased property through our network, but those who had taken our advice, and for so many reasons, we were already getting people out of California. That's been what we've been doing since 2003, is helping people sell their properties in California and exchange them into other areas where we saw demographic growth, job growth, landlord-friendly laws. So for the people who followed that advice and purchased properties through our network, they were actually seeing higher collection rates than they've seen in the past, much stronger applications for tenants, and rents going up, actually. So just overall, one of the best years ever.
That's been an interesting fact. Like we've had a very strong financial year for as an investor. And when we talked last 6 months ago, a lot of us were like, I don't know what the hell is going on. Like, so what should we do? Yeah. And but today, a lot of real estate investors have actually done fairly well, but not all have. And some have really struggled. And I know volume has gone down on purchasing for a number of investors. And that's what I hear from some of the people out there. It's like, I'm waiting for something to happen so that volume goes up.
I mean, that's the crisis. That's the crisis, is trying to find inventory and competing against so many qualified buyers, really from all over the world. But mainly, you've got really well-off people from San Francisco, New York, Chicago, big cities, LA, who now are taking their money, and they have a lot of money, and going into kind of competing with investors. So that's the crisis, is finding the inventory today. That's why builders are busy building.
Yep. And that's
even the institutional buyers, the Open Doors, the OfferPads of the world, Zillow Offers, we've seen their purchase volume just crater this year.
Yep.
And if you think about their value proposition to a seller, it's a guaranteed sale that can happen quickly. And if you look at traditional home sales right now across the country, the average days on market is less than 2 weeks. And usually these properties are getting multiple bidders. So, how does an iBuyer compete with that? And candidly, how does an individual investor compete with that? It's a real tough market because demand has outstripped supply now pretty dramatically. And demographics suggest demand is going to stay high because the millennials are hitting prime home buying age. You have historically low interest rates, which turns tire kickers into buyers. And then this pandemic, oddly enough, accelerated the trend of people moving from being urban renters to suburban homeowners, because apparently being quarantined in a 700 square foot apartment with a toddler wasn't quite as much fun as they expected. So we're seeing this move to the suburbs and the far suburbs. And to Kathy's point about home builders, that's where they're building. They're building bigger homes. They're building them further and further out in the suburbs, and that's what's going to traditional home buyers right now.
So maybe there's more of a speculation on where, as an investor, we should be focused on. Should we be focused in core city areas or high commercial zoned areas and so forth? Or should we be, like downtown Seattle, where like I'm in my neck of the woods, or San Francisco, where Kathy was at one point, right? Or your headquarters is. And should we be focused on the suburbs? But will that stay that way? Like, is that a great long-term investment area to go invest in? Or will people come back to the major cities? But not all major cities have been affected, though, right? Or affected. Infected is the wrong word. And affected. And New York's been hit hard, New Jersey, that kind of stuff. But there's a lot of cities that are still thriving despite what's going on with COVID. And I think that has more to do with the lockdowns and the and situations, which ones are still open. But are you seeing that differently, Kathy, out there in the market, or as far as?
Well, I don't do a lot of business in California. We don't build subdivisions in California anymore. The permit fees and the regulations just make it too cost prohibitive, and we just won't do it. I think on our Dublin properties that we that we re-entitled from office to residential, it was $120,000 or $130,000 just in permit fees alone. When we decided to move our operations to Reno, it was like $6,000 or something. So we're just not building in California. But your question of, is it a good place to invest? I mean, it's certainly something to keep an eye on. If you've been wanting to own in California, you might find some deals, although even my niece, who does sell San Francisco real estate, says she's busier than ever. And I am actually moderating a multifamily conference tomorrow, a panel tomorrow. And I asked a lot of the multifamily owners who have apartments in San Francisco, New York, LA, what they're going to do. Has it been difficult? And they said, yes, collections have been difficult. But they're not selling, and cap rates haven't actually risen in those areas. So, and that may be because they're not selling. They think those areas will come back after this. So I found that interesting because maybe this is the chance to buy a multifamily in San Francisco if it's not going so well, but that may not be the case if no one's selling. So it just depends on how much reserves they have.
That's counter to what we're seeing in other types of commercial properties, where cap rates are going up, partly because prices have come down and partly because interest rates are still so low.
Well, let's hold on, just for listeners and viewers. Specify, are we talking about when we're saying commercial? Because a lot of times in the loan industry, we say commercial. Commercial means multifamily and also commercial buildings. But if we're talking specifically here for investors, are we talking about commercial buildings versus multifamily buildings? And just so we can clarify on that.
Yeah, I was really talking about both. So that's a good question. Okay. If you're looking at office buildings, retail centers, hospitality, in addition to multifamily, and in every segment right now, with probably the exception of urban multifamily, we're seeing cap rates go up because prices have come down and interest rates are low. And so investors who have put some money away to buy distressed assets are coming in and grabbing those properties. The other thing we're seeing is nationally, and I don't know, Kathy, maybe you're seeing the same thing, but rental rates in the biggest of the metropolitan areas have been going down for the last few months, but we're actually seeing rental prices go up in the suburbs.
Oh, absolutely. Weird.
That's huge. So so why would you want to live in downtown? I'll just speak of Seattle. Seattle's rental market has dropped 12% in the city as far as rent prices and so forth. But if your main reason why you lived in downtown Seattle was so that you can walk to all the restaurants, the shows, the shops, all that great stuff, the amenities, and then you live in this great high-rise apartment, but there's only 2 elevators and there's only one person allowed in the elevator at a time, and you live on the 56th floor. You start adding that all up, you're like, why am I living here? Right? So, and you're not walking to Amazon anymore because they allow you to work from home, and we're seeing that in certain areas, especially on the Seattle rental market side. In downtown Seattle area, but on the suburbs where all my rentals are, those are spiking up, and we can't even keep our units, unoccupied. They're always getting rented out, right? So we're definitely seeing that. I hope it stays that way for my own benefit. But but you have some of these submarkets that are out there that people have flocked to in since COVID, and we've seen dramatic home price increase in some of these markets. I mean, Bozeman, Montana, Boise, a bunch of other places that are out there. Phoenix is going gangbusters right now. And some of these, and I remember when we were really seriously looking at one of these markets, and I had many, many people tell me in those markets that live there going our local economy do not support these house prices, right? This is coming from California, West Coast money, that kind of stuff to increase these house prices so dramatically. Which made me double guess, should I invest in those areas if the only thing supporting it is rich money on the West Coast? And what are your thoughts on that as a house flipper?
I think Rick and I could probably both talk about that because we're both from California. At least I'm born and raised in California, and we have been loved and hated for many reasons. Loved because for a while, Californians have moved to Oregon and Washington, bringing our money with us, driving prices up, and so. That's really great for people in Oregon and Washington who already owned assets and saw their values go up. And the people who are trying to buy really hate California money. So, you need to get there first before we get there. That's the bottom line, and that's what, obviously Californians have been moving to Arizona, to Nevada, and now Texas and Florida, and certain other markets. But, we do bring our money. We drive prices up, and generally builders it takes a while for them to catch up.
I don't know. Idaho.
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 Yes, Idaho.
Yeah.
Mm-hmm.
Yeah,
Montana.
Boise's gone up dramatically. Yeah.
Well, 2 years ago, my builder partner came to me and said, I'm having such a hard time finding land. He was looking in Boise, he was looking in Sun Valley and all around Idaho, couldn't find anything. And, but his daughter went to Bozeman. And when he went there, he's like, I cannot believe, this was 2 years before COVID, what a boom was happening there, because you already had a massive amount of baby boomers looking for a great place to retire that was affordable. But then you add to it, there was already a lot of millennials who were able to live anywhere. Our company at Real Wealth, we've been virtual for 10 years. So, COVID just sped a lot of these things up. So when he saw that there was this boom in Bozeman, not enough property, and no other builders, no other major builders, national builders were not there, he was able to get some farmland really cheap. We're building a few hundred homes there. They have been, and this was 2 years ago. And when we brought this to our investors at Real Wealth, they're like, Bozeman, and the whole idea is, well, at least there's no competition. It's just going to be us up there. And we have wait lists for those properties. People are buying before we've even subdivided the lots. They're trying to reserve those lots. And prices have gone up dramatically. But even in areas like Cincinnati, this blew me away. Our property team there, who helps our investors buy in Cincinnati, it was always a boring little market that people like just for the cash flow. Well, properties have been going 20% over asking price, because Cincinnati, another area where builders were like, I'm not probably going to invest a lot of money in Cincinnati. So they weren't building there the way they were maybe in New York, LA, Seattle. So there wasn't enough competition. And yet I personally think, Rick uses data. Sometimes I just use, female intuition, whatever it is. But it's like, look, you got all these all these millennials that were misunderstood. They're just normal people who also have children, who also form families. They weren't not doing that. And all of a sudden in March, they are home trying to do husband and wife full-time work at home with babies running around. Forget about it. You're going to move back to Cincinnati, have mom and dad watch the kids. That's all I can figure is going on, and why even these tertiary markets and rural markets are taking off as well.
It's been a really weird year, but let's talk about the speculation then into 2021 and what that all means. If areas start to open back up, and there is a supply demand situation here, and mostly we're talking about single family right this second. And when we're talking about supply and demand, don't get me wrong, I want supply to go up, right? And in some category, but also as a house flipper, I'm like, it's so freaking awesome there's no supply, because then when I go to sell, the house is selling for a heck of a lot more. I've had so many times over the years in my market where I buy a house thinking it's going to sell for 400 and it sells for 500, right? Or buy a house for 600 and it sells for 650. It's just awesome, right? As a house flipper. So that's a supply and demand situation almost always. But now we're at a point where we don't have enough supply for us to even go find to buy, because everybody wants it, even off market, right? Is there something that we can speculate on? And this is speculation, these are all educated guesses, that might increase supply coming into 2021 at some point out on the market?
Yeah, there's three things you can look at. One is assuming we do get this virus under control, assuming the vaccines work and people are willing to take the vaccine and so forth. You're going to see some existing home inventory come back to the market that the sellers would have moved earlier, but they candidly were nervous about sick people being in their house, or they were nervous that their job might not be stable until the virus is under control, and they felt more comfortable being where they were financially than taking on another commitment. So you'll see some existing stock come to market. The other thing you can look at is that there is a backlog of foreclosures building. That absolutely is true. It's not going to be anything like what we saw last time. We entered this pandemic with 0.5% of loans in foreclosure. That's 50% of normal levels. So if it quadruples between now and the end of the pandemic, you're still just barely above normal levels of foreclosure activity. But there were 250,000 properties in foreclosure that basically got stuck in limbo because of the moratoria. Those will all come to market at some point. So you will have that. And then to Kathy's point, if you look at the housing start numbers over the last couple of weeks, or last couple of months rather, you see the builders now on an annualized basis up over 1 million new units being built. So those are the three areas I think you wind up seeing more inventory. You have the foreclosure backlog. You will have an increased number of foreclosures and defaults because of the economic downturn compared to what we would normally see. And again, so you have all three of those areas. And I know most of the people on the call today are probably most interested in the foreclosures.
Deals. We want deals.
Well, it's important. I think it's important for investors, and this I have a very strong opinion about this. It could be wrong, but at least it's mine. And that last cycle, most of your deals were with bank-owned properties. It was the REO inventory. So somebody got foreclosed on, nobody bought at the auction, the bank repossessed it. They eventually get around to remarketing it. I don't think that's the case this time. I think the majority of properties this time are going to be sold before the auction ever takes place. 70% of homeowners have more than 20% equity. If you have 20% equity in today's market, with the demand being what it is, and you lose your house to foreclosure, you've done something terribly wrong. There will also be short sales, not a huge number, but that FHA area we were talking about earlier, those borrowers don't have the equity. I think you'll see short sale opportunities for investors as well.
I think I agree with your speculation, especially on the for the foreclosures and why some people won't go to foreclosure, even though they might be in default, is because they have equity this time. So unlike the last major crash, everybody was upside down, or a lot of people were upside down, and so when they went to foreclosure, they were upside down. Or that's why you had a lot of agents that all of a sudden super specialized in short sales, and you saw short sales everywhere. And I'm speaking from experience. We bought a ton of short sales. And we had a whole tactic for that with how we would go about doing it. And so, but for this go around, you have all these servicers who are going to be reaching out to these people that are in default and saying, hey, you could just sell your house, right? Kind of a thing, instead of go to foreclosure, because a servicer doesn't want to have to go to foreclosure if they, and whatnot. They'd rather just, get you off the books and move on, because it costs them money. They have to maintain your property, right? There's a bunch of, they have to rekey it. They have to check on it. There's a bunch of stuff that has to happen in those scenarios. And if it's a judicial state too, then it could take years to get to that entire process. So I could definitely see more houses going on the market. And then one other speculation, if you're an off-market marketer, whether you're an agent or a wholesaler, I think that you'll have more opportunity in that category, because more people might be open to sell because they have equity at that time.
Yep.
But you're still going to get people that go to foreclosure, even with equity, just like you would have pre-COVID, right? And because there are still people that put their head in the sand thinking nothing's going to happen, or they got overwhelming circumstances and they just can't handle it. And there's people that just do that anyways, right? So, but I do believe that, I think somebody said this, and Kathy, we can transition to this if you want to bring it up. But this year was the year of the mortgage broker. And maybe next year will be the year of the real estate agent. And if you know what you're doing, right, out there as an agent and or wholesaler, off marketer, right? Aren't you guys starting something with that? Are you guys doing a nationwide?
Yeah, we are. We're starting a national brokerage, and we're going to be looking for agents who can find those distressed situations and help that homeowner sell, instead of getting to a point where it goes back to the bank, so that they don't lose everything. And that will definitely be the opportunity. It's just, the thing that makes real estate ever so exciting forever is that people think, oh, okay, this happened last time, so it's going to happen this time. Yeah. And people are so driven by fear or greed, those two things. And the fear is, oh my gosh, I can't buy anything. There's going to be a housing crash just like last time. I don't want to buy at the top. You definitely don't want to buy at the top, and then the greed is, oh my gosh, I can't wait. I missed out in 2009, or I love 2009. I want it. I want that again. So, we're driven by these emotions versus what's really happening and understanding it. And we're also so affected by headline news that, you've
No, we're not. Right?
Some people are.
Headline news.
A lot of people are still affected when they see something from, everybody's trying to get PR, everybody's trying to get on TV. We're talking about large companies. So they're going to come out with outlandish topics and press releases to be able to get quoted. And so the quote of, oh my gosh, foreclosures are doubling, when you're coming from a tiny fraction, and it's doubled, it sounds terrifying as a headline, but when you compare it, it's right, Rick. I mean, it drives me crazy when I see some of the colleagues that we even know coming out with these headlines. It's like, don't mislead people like this. They're just
like there's a great book actually on that point. I would recommend this to everybody. It's called Bad Science. And it's Tim Ferriss recommended it one time on his podcast. And I'd have to look up the author. I can't remember, but I've read it. I loved it. And it actually taught exactly what you're talking about, Kathy, and how to read statistics when it came to like headline statistics.
Mm-hmm.
And when you go like, foreclosures are doubling across the nation. Well, foreclosures have been zero. And so throughout the nation for 6 months. And when you go from 1 to 2, it's double, right? And so
or 8 or whatever, tiny percentage.
So it's stats are what's the stat like 50% of 100% of the time I'm 50%. I don't remember. Anyway, 50% of the time I'm 100% right or whatever. And
then also there's this incredible fear that there is that we're in a bubble, and certainly there are bubble markets there. But when you look at, you also have to understand things have changed a lot in the last 10 years, in the last 20 years. Things have changed. So when let's take a market like Dallas, where when we started buying in Dallas, it was 2003. There was no bubble. It was 26% undervalued in Dallas, while the rest of the country was in a complete bubble, right? But Texas didn't do the crazy loans, and it was just the beginning of its boom, with its economic boom, with so many businesses moving there. So when you take the Dallas, Texas of today, and I'm talking about from an employer perspective and a population perspective, it's not the same place that it was 10 years ago or 20 years ago. So how could the real estate values be the same? So it may look like a bubble when you look at the graph and it's like boring, and then it's this. Well, it looks like a bubble, but it's not, because the average person can now afford the average price. They can still afford the average price, even though that price is much higher, but you have a whole bunch of people who have moved there that have higher salaries. So again, it's really important to understand what is a bubble and what isn't a bubble. I mean, Rick, what would you say about that?
I don't think we're in a bubble at all. I think there are probably a few markets where we'll see a correction. And I define a correction as, up to a 10% adjustment in prices. So, we've seen Seattle have astronomically high price increases over the last few years. San Francisco just got goofy. But San Francisco is always a little goofy.
Always.
But your point about affordability is really an important one. Both NAR and the California Association of Realtors recently put out numbers that said the median home price was at an all-time high. And if you dig into the numbers, they also tell you that the average monthly mortgage payment is lower than it was a year ago. So it's hard to overestimate the impact these low mortgage rates have in terms of affordability. And the other thing to consider is that while home price appreciation has been outpacing wage growth never took the huge drop that home prices did back during the Great Recession. And home prices nationally went down 35%. California, Florida, Nevada, it was 50 to 60%. Wages never went down 50 to 60%. So they've been steadily either maintaining or growing. And if you factor in inflation, wage growth, and interest rates, even though the house prices are the highest they've ever been, the affordability is not nearly as bad as you might expect. I think the biggest problem most buyers have is finding the cash they need for a down payment. It's not the monthly payment they have issues with. It's scratching up enough money to buy the house in the first place.
Absolutely. And that's where, and unfortunately, as you start to get furloughed or have situations where money is a little bit tighter, right? And it's kind of getting harder and harder. Cash has always been a challenge for U.S. Most people in the U.S. to be able to save. Our savings rate sucks, right? And that's something that we should all be more talking about as a nation, is how to get out of debt and save more money. But then that would hurt the fiat system and everything else we got going on. So that unfortunately is what drives our economy. That's a different topic altogether, so that we don't need to get into. But I want to switch into some of the policies. Now, there's a lot of speculation on policies that have been announced pre-election and might be coming down the pipeline. Some policies in some states that are already like getting enacted when it comes to real estate, and then maybe some future policies that we already see possibly happen, especially with the new administration. That still isn't official, but who knows if it comes through. And so, Rick, you always have somewhat of a pulse on this. So when it comes to real estate policies and some of the speculation of what that might be, what are some that might have already been are on the table right now that might change the real estate investor situation?
There's two that are definitely on the table. One is, I think you were talking about this earlier, the $15,000 tax credit for homebuyers. That is intended to help people to be able to afford those down payments. I'm not sure if it's a smart policy. It seems like a solution in search of a problem. Demand is not the issue we have right now in the marketplace. So stimulating more demand, I think, actually runs the risk of making properties even more expensive. The one that's more germane and people really need to pay close attention to is the Biden team has talked for a while now about eliminating the 1031 exchange program, believing it's a kind of an unfair tax advantage for rich people, and that's a theme you'll hear a lot from this administration. But that's something that if you have connections with, your senator, your congressperson, to get out in front of, because that would have a significant impact on the investment community. Bernie Sanders had campaigned about having a 30% flipper tax. Have not heard that out of the Biden administration, but since some of Bernie's advisors will probably be some of the advisors in the administration, again, something to keep an eye on. That changes all the dynamics in the flipping market. And then we can talk about this in more detail if you want, but then there's the wonderful bill in California, Senate Bill 1079, that basically mucks up the auction process to
this one already passed, right?
This passed. It's supposed to go into effect January 1st. And what it does is, on any property that's sold at a foreclosure auction, it holds the sale for 45 days until owner occupants or nonprofits have an opportunity to outbid the winning bidder. And it just, again, it was intended to provide more affordable homes. It was intended to prevent investors from doing bulk purchases, which nobody's doing right now, and intended to keep the institutional guys from gobbling up the inventory, which they're also not doing right now. So it's a great solution to problems that existed 12 years ago, but really will probably do exactly the opposite of what it's intended to do once it's in place.
And we don't need to dive into this one too deep, but essentially you're saying that house goes to auction, investor has to buy it, but then California or whoever the trustee is at that time holds on to it, doesn't not give it to an investor for 45 days to allow residents or homeowners to be able to bid on it and on that new price, or nonprofits. But then they have to buy it cash for the most part, unless they have some sort of non-traditional financing, because they're not going to be able to go do the traditional finance route typically.
Well, and we were talking about this. So, a typical hard money lender is not going to write a loan to that resident, because they don't do 30-year fixed rate mortgages, and the traditional banks also aren't going to loan on that property because it's an auction property.
Yeah,
so I'm not sure exactly how those residents are supposed to buy the house, but you never know.
Unless they're rich and they already have lots of money and they can buy cash, so which doesn't help with affordability. So it's kind of a moot point. But let's go back to the 1031 exchange. And for those of you guys listening that aren't familiar with that, 1031 exchange is just a way that you take a property that you've held on to for X amount of time, if it's a rental, whatever, multifamily, commercial, and then and you can also do this with stuff that's not even real estate related, and then you sell it, and you then transfer your gains into another, in this case, let's call it property that's worth at least $1 more, technically, or you spread it out amongst multiple properties that equate to at least $1 more more, and you defer the gains, right? So you don't pay taxes on that money. You're not getting tax free. You're just deferring it, which is like your traditional IRA. And then at that point, when you finally sell 20 years from now, maybe you get taxed then, but you're just reinvesting the gains tax deferred. And the misconception is that's a rich man's tool, or rich woman's tool. When we talked about this the other day, the three of us, that the vast, like 95% or whatever of investors are your neighbor, right? Are individuals, they're homeowners, they're people that have a little bit of retirement, they have two flips, right? Sorry, two rentals, right? They're Kathy's clients, right? And roughly, as far as single family is concerned, how many the institutional investors, how much volume do they own right now in the market for single family?
If you take all of the institutional investors together, they own less than 2% of the inventory.
Yeah. So that means the other 98% are either homeowners or they are landlords that are your neighbor, your friend, right? Us, right? Kathy, other people. And 1031 is a huge, huge tool in order to continue to be able to build, develop, grow, redevelop, all that great stuff. Now, what if we get rid of the 1031? What would investors do? What do we think that might happen to the real estate? What do we think might happen to the real estate market?
Well, I'll just give a personal opinion that is probably contrary to most of the people who are listening. I got into this business because of the exchange, and I just couldn't believe what I was hearing. That is why I am who I am today, because I was like, what? How come people don't know about this? My dad he had owned an apartment. He was a dentist, and they sold without telling him. He got a letter in the mail. He ended up having 6 weeks to find a replacement property. He called all the kids. I was the only one who was like, oh, I'll do it. So I helped him find a property. Rich and I lived in it till he passed away. The property stepped up to market value, and those taxes disappeared. And that was how we got into our first home. And I was just really quite shocked about this tax loophole, or whatever you want to call it. So I personally think that, I understand why there is a 1031 exchange. Tax loopholes, legal loopholes. Oop, what was that?
Tax strategy.
It's tax strategy.
It's not like some trick. It's an actual tax code. So
it is a tax code, and I understand, that the tax code is meant to bring Listen, investors aren't going to invest in something that doesn't make them money. So tax codes are made so that investors will invest. So I understand that part of it. What I think will be the opportunity if this is changed, I kind of doubt it will be changed on residential. It might on commercial. Who knows? It's going to be a long 4 years. We'll find out soon enough. But it's still, if you have to pay the capital gains rate, it is still lower than other taxes. So there's that. So you pay your tax. It's not so bad. Or you invest that money in an opportunity zone and you make more money and you pay it then. So right now, I believe the Biden administration is excited about opportunity zones. It's a way to bring investor dollars into areas that could use retrofitting and use investor dollars. And that may be what people do. It's not nearly as good as the 1031. If you're thinking about selling, do it now and do the 1031 while you can. But I believe there will always be some kind of tax code that directs investor dollars where the government wants it to go.
I agree with that on the side. Trust me, I love 1031. It's the main reason. I think if you live in high appreciating markets or areas you could force appreciation, it's one of the best things you can do to be able to build your portfolio is 1031 out of those into something else, right? And we do that with our BRRRR strategy properties all the time. And but on the other note, like, we are investors and we're going to go, adapt and overcome and do whatever we need to still invest. And people are going to figure this out. There's one thing, if the 1031 went away, is that you probably have a lot more seller financing opportunities as well. And because you also you can't discredit the fact that you got the person that's owned the property for 30 years or has rolled into 20 other properties, which means they deferred tons of capital gains, that if they sell that property, sometimes you can have 100% tax, like when you go to sell. So if you've deferred for too long, right, and you've depreciated everything for so long, you get no money right at that point once you sell the property. Mm-hmm. So now all of a sudden they can't 1031, so they might want to seller finance so that they don't get 100% tax or 50% tax or 60%. Despite capital gains, that's still a situation if they've held it onto it for too long. So that might create those other opportunities of seller financing even. But either way, we'll figure out an opportunity. Mm-hmm. But either way, I'm going on the record saying it's really stupid, like, for at least their argument for why they should get rid of the 1031 as a rich person's. No, it's not, right? It's a strategy that people have done for years, and people that are low income, middle income that get into the real estate, it's how they're not in low and middle income anymore. It's because of opportunities like that.
That's true.
So
yeah, that's true. It's available to anybody.
So
that's how I got started.
They're all looking for revenue for the government right now, which is one of the reasons I don't think Fannie and Freddie are going anywhere anytime soon, because they're basically ATMs for the government at the moment. And I think they have the mistaken notion that if they eliminate the 1031 exchange, program, there's going to be a windfall in terms of tax receipts. And I just don't think that's really going to happen. So it seems like on paper that's something they'd be thinking about doing, but the reality is going to be very different than what the theory is.
Well, I mean, that's why they raised all the state income tax, or what they want to in California, is because they'll make more money, right? So it doesn't work that way. They just leave California.
Yeah.
So let's talk about then, like you brought up Fannie-Freddie. So there's speculation right now that the Trump administration wants to privatize Fannie-Freddie back to where it was pre whatever that act was that made them non-privatized. And I believe you're quoted on a article saying that you don't see that happening anytime soon. So in that case, Rick, why on one side, why would this be important to investors for Fannie-Freddie to be privatized versus staying nationalized, and what that actually means for the housing market one way or another?
Fannie and Freddie kind of backstop the mortgage industry, if you think about it. So they provide liquidity into the market that makes it possible for people to get loans. If you're flipping a house and you want somebody to be able to get a mortgage, having a Fannie and Freddie up and running and viable is kind of an important consideration. Again, like we talked about earlier, 2/3 of the mortgages out there are backed by one government entity or another. And that was true when Fannie and Freddie were those sort of pseudo-private, backed by public entities before the conservatorship, and since they've been taken over by the government. A big difference since then is this thing called a sweep, which takes all of their profits and basically sends them to the U.S. Treasury. The Trump administration and Director Calabria have talked about trying to fast track the end of conservatorship. It scares me a little bit because the last thing you want to do right now is destabilize the housing market when it's really the only part of the economy that's hitting on all cylinders. And that if they exit the wrong way and get out of that conservatorship the wrong way, that's a very real risk. You could disrupt the entire mortgage industry, which would disrupt housing. Not good for investors, not good for anybody. And Director Calabria had been talking about exiting in June of 2022. That was his target date. So to take what was going to take a year and a half and do it in 30 days just strikes me as being a bit reckless.
Fair enough. So we'll see what happens, right? And what that might happen. I mean, there's also speculation on, I'm one of these speculators that I think that, I think rates, should rates stay as low as they are, right? And should rates actually go up? And would it be better for the economy and better, as a whole long term for rates to stay low, or would it be better as economy and the dollar for rates to go up? I don't know. So
that's where you need Jay Scott, because he at least sounds like he knows what he's talking about with economics. But one of the things to keep in mind with this low interest rate environment we're in, and it goes beyond mortgages back to Fed policy, is we just run up an extra $1 trillion in instant deficit because of the pandemic. It looks like there's another bill about to pass for right around $1 trillion. That low interest environment keeps the government debt payments from skyrocketing. Mm-hmm. So I believe, whatever administration happens to be in office, they're going to encourage that low interest rate environment, at least for the time being, both to get the economy stimulated, but also to keep the government debt payments from ballooning, which would happen if interest rates start to go up.
Yeah, Doug Duncan just gave his forecast, and he says he thinks that interest rates will be around 2.8 in 2021 and 2022, 2.9. So it doesn't look like there's a plan for rates to go up. When the Fed did increase rates, when a tightening was happening, basically the Federal Reserve will increase overnight rates if they're trying to slow an economy down, and they will lower rates if they're trying to speed it up. So when they were trying to kind of slow things down in 2018, interest rates went up as well for mortgages, and that was when we saw a few months of just like people, it was just like no sales. And I'm in the building industry, and let me tell you, it affected us. We did not have sales, and most builders didn't have sales at the end of 2018. So then if you remember the battle with President Trump and the Fed, he's like, you better lower rates or I'm firing you. And so somehow that worked, and they started lowering rates, and then the market took off again. So we are extremely rate sensitive. I think we've seen just this year the importance of the housing market, that the Fed announced early in March that there would be unlimited quantitative easing that would go to the banks, that would go to continue the lending, which is what has been happening, just money created. And it's much of it has gone into the real estate industry to keep these loans available and low cost. And again, it's like Rick just said, our industry is one of the ones that's really working, along with, I guess, online sales and Amazon. Real estate has just gone gangbusters, and it's because of that. So I very
as
unlikely.
Long as we keep printing money to lend out, then it's
then all is well.
And all is well. Forever and ever. That's never going to blow up in our face or anything, right? So
never.
More mortgage-backed securities being packaged up and all that great stuff, right? We're not going to see that again, are we? For I don't know, right? Anyways, so that's interesting. So what's the strategy then for 2021? Let's say, so Kathy, if I'm let's just say I'm a real estate investor, right? And my market is super hot. I don't know, call it Seattle. And I'm looking for somewhere else to, get into. What kind of indicators should I be looking for to be able to possibly go out of state, look in different markets, reinvest, whether it's flips, rentals, whatever it might be? What should I be looking for right now, especially after this conversation with what we've had, to maybe jump into possibly as a market?
Well, we specialize in buy and hold real estate. And so what we've been looking at for the past 18 years is, first and foremost, job growth, second, population growth, and then affordability. And if you can get those three factors, then you found yourself a pretty good buy and hold market. If you can add a fourth factor to it, and that would be infrastructure growth. So any city that is actively investing in itself. Back in 2015, I think, we looked at Detroit when everybody was staying far, far away from Detroit. Why? Well, first of all, it had gone through bankruptcy, so it let go of a bunch of debt and restructured, and bankruptcy can be a wonderful thing. From there, and except for the creditors, not so great, but the person going bankrupt, it's a great thing. You don't have to pay those debts generally, or it's restructured. So that happened. And then two billionaires came in and tried to revitalize Detroit in the downtown, and each invested a couple billion to do that. And it worked. So we saw the affordability, not so much job growth and population growth, but that affordability and infrastructure growth, and just what seemed too good to be true. If you're buying houses for $30,000, $40,000 that rent for $900, it's probably a good deal. So that just made sense. We went in early. So if you can combine that and just follow where the job's going, that seems less important today, right? It's where's the population going? Where are the demographics headed? And you have a baby boomer population that is looking to retire in affordable places. Now you've got millennials who are starting families, who really got a late start in life because of the last recession. They are brilliant and many tech savvy, and they seem to be able to live anywhere. And now you've got the Gen Zers who are getting out of college and not necessarily wanting to go back and live with mom and dad. My own daughter, she came home March and April, and by May, she said, I'm out of here. I'm going to live with my friends at San Diego State. Even if we can't live on campus, we're going to just rent a house and be together. We don't necessarily want to live with our parents. So you're seeing the Gen Zers coming online now. So following the trends, the demographics, where are people going? Where is it affordable? Where are the jobs? Where is it cool to live? And if you can get a cash flow from that, so it leaves a lot of markets today. I mean, generally we like to offset we have a single family rental fund. It's very small, about $5 million fund, just testing the waters. And we kind of offset what we saw as growth markets with cash flow markets. So we bought half our portfolio in Florida and Texas, some in Georgia, the Carolinas, and then we offset that with the Midwest, Ohio, Detroit, and Indianapolis, and those areas to have cash flow in one place and some cash flow, but more growth in the other. Well, the houses that we bought in Florida, some of those went up $150,000 just in the past few years. That was great. We got some appreciation there. What we didn't expect is we got it in the other markets as well. So, it's been, there's a lot of good places to invest today, bottom line.
That's good to hear, because I've been, I'm a pretty extreme conservative pessimist when it comes to investing in anything, right? I grew up very, very broke, very, very concerned about losing money. If you look at my psychology profile for the last few decades, it's been like, don't be broke, right? And which is not a good way to become wealthy, by the way. And because it's not their same mentality, but it makes me very hesitant when it comes to looking at new markets. Where do I invest? Because I'm afraid of making a mistake, right? I'm afraid that I'm like, okay, I built up all this, I'm awesome where I'm at, right? I've flipped tons of houses, and I have a bunch of rentals and I'm cool. I'm afraid of losing it, right?
Of course, yeah.
And so if I all of a sudden shift to a new market or new strategy, which is an actual conversation right now in our company, I'd like, oh, I don't want to backpedal. I don't want to go do that and make a mistake. Like I've been talking since 2016, the market's going to crash, whatever. Which maybe I'm, not talking about that anymore. But I've just been concerned. So what can you like if I'm coming to you or Rick, maybe you can help me out too. Like, how can you alleviate some of my concerns as an investor so that I don't feel like I'm making a mistake if I go to a new market or a new strategy and shift gears from what I'm used to doing right now?
I'll just jump in and then Rick's going to have I'll just say it's harder for you. It's harder for you because you're an expert. For the people at Real Wealth, they're busy. They have other jobs. They don't have time to do real estate. They're just like, hey, this is good. We like this. You're used to getting the great deals and fixing them yourself. It's kind of like if you were to buy a new car when you're used to buying old cars and fixing them up or something that. It's like, I'm not getting as good a deal as if I did it myself. So it is harder for you to just trust someone else to do that work for you unless you pick up operations and go do it. What were you going to say?
How do I overcome that? How do I overcome that fear? Like, I don't want to lose everything, right? And if I am going to go into a new market, then, maybe do I just got to suck it up and go do it? Or besides looking at some of the indicators that you had mentioned and whatnot, but like any other advice other than that, like just go do it or what? You can't give me advice. All right, whatever.
That was for you, Kathy.
Is that for me? Oh, I would start with one. Honestly, I'd start with one. Go to a market. You're probably young enough to go travel, but you can do so much online anyway. But just figure a market that you like and dig into it. Get to understand it. Find a team there so many people. Find a good team. That's what we focus on, is finding a great team that will take care of us. You have to pay that. You have to pay them. So you're not going to get as good a deal as if you did it yourself. But if you did it yourself, you'd have to pay for all the travel costs to get there and having a team there in the hotel. So it's a trade-off. It's a trade-off. It's the difference between active and passive investing. And it's just not the same. That's why if people go online and say, oh my gosh, we could get better deals doing it ourselves than Real Wealth. Well, of course you can. You're there. We're not. You've got to pay someone else to do it for you. But if it's still, with all that said, what a lot of our members are doing is buying new. Again, not as exciting, not the kind of cap rates you've probably seen, but it's a new home that if it's thousands of miles away, it's kind of nice to know that it's new and it's got a warranty. And usually new homes are in the path of progress in most areas. And so anyway.
I guess that goes back to like also saying that you're a cash flow business, right? So it's the like when it comes to that kind of advice, and I appreciate that. But Rick, what were you going to say?
Yeah, just to kind of piggyback on what Kathy's saying, if you follow investor activity, if you follow the money, we're seeing the same thing that she just described. We're seeing the Southeast and we're seeing the Midwest, and it's because of population growth and it's because of affordability. And in a lot of those areas, you actually have a higher percentage of rental households than you do of owner-occupied households. So there's a thriving rental market in a lot of those areas. Two things I would kind of add to what Kathy was talking about. One is, there was a question here about whether we've seen a fundamental shift away from urban areas. I don't know that that's the case, but I think we are seeing a movement from primary markets to secondary and tertiary markets. So I would be keeping my eye on those second and third tier cities right now for investment opportunities as we see a more distributed workforce across the country. When you have Mark Zuckerberg from Facebook talking about having employees in Nebraska and Iowa instead of Silicon Valley, to me, that's a significant kind of comment. And the other thing, and this is going to sound self-serving because we have this data on Realty Track, so I apologize in advance. But I would be, especially if you're looking at staying in your current market, I would be looking at people in the early stages of default and doing your investor door knocking or working with a realtor to go find those people. And if you're a buy and hold investor like Kathy's talking about, you don't necessarily need to get the best deal on a house because you're going to get most of your money through cash flow. And if you can work with one of those homeowners who's in distress and get a number somewhere between what they owe the bank and what they could get top dollar in the market, as that clock ticks toward the foreclosure auction, I think that gives you some opportunities to pursue.
That sounds good. Yeah, definitely. I do agree with that aspect too. Like right now, if you can find a way to get in front of, and we said this earlier too, in front of people that are in forbearance or possibly, taking down the foreclosure side, then, you might be able to help them out because they have equity and so forth and jump onto that before other people, especially if you're a good marketing realtor or a good marketing off-market marketer.
In some cases, those people can also become your tenants. They might be in a
well, if they're not paying their bills now,
just saying.
Yeah. Well, I want to go ahead.
Tarl, I just want to say that the city that has recovered the most of its jobs, at least according to Zonda and Meyer, I think it was Meyer's research, is Indianapolis. They've recovered 76% of their jobs or something like that. So there's certain markets that are just resilient that we've been investing in now, second recession, that just didn't feel like there was a recession. I mean, when I helped people sell their California properties in 2005, 2006, and buy in Texas, people would just laugh at the prices we were paying, because we were paying $140,000 for a new home that sounded like a piece of cake to us. Like, you can't buy anything like that in California. But in Texas, it was like, oh, that was really expensive because the average price was $120 or something. And we were spending $140 on a new home in a nice A-class neighborhood. So any local investor just thought we were stupid Californians. What we were doing, and we were, but what we were doing was buying 10 of those in the path of progress, where new freeways were coming in, where jobs were coming in. Those properties tripled in value since then, and the cash flow came in. Rents went up every single year during the worst housing recession ever, well, besides the Great Depression. So, here we are, second round, with another recession that is pretty scary, being a landlord at a time like today when we've got eviction moratoriums. I mean, who would have ever thought the government could tell you who you can keep or not keep in your property? That's not something many of us anticipated. Yeah. Even with that happening, we have not been affected. We have not been affected because we bought in areas where they tend to be more landlord friendly, and where, again, I'm not getting political, but you have to be political when it comes to real estate. We buy in areas that are business friendly as well. And so many of these places have kept their doors open during this time. And so not as many people have lost their jobs, and it's kind of been business as usual.
So I guess we'll wrap up on one. We didn't really dive into this too much. We spent a lot of time on single family today. And I kind of want to just at least touch on that. It sounds like all three of us, I mean, I agree with this too. Single family, we all were like, yeah, it's going to be pretty good. Most markets, you're good to go, right? Like, just pick one, like based on what we just talked about, like, and commit to something and deal with it and stop being a sissy, Tarl, that kind of thing, and just go for it. So we all agree on that. Great, cool. But when it comes to other niches like multifamily and commercial and whatnot, do we see the same resiliency in the market in those two niches in real estate, in multifamily as well as commercial? We didn't touch, and we only have so much time, but do we see the same thing in 2021, where those two niches are going to continue to go forward and grow and multiply and be awesome and not be as impacted?
Multifamily and industrial?
Multifamily and commercial. Sorry, like commercial, retail, office space, that kind of stuff. Yeah, we only briefly touched on that, but I want to kind of wrap up on that.
Quickly, multifamily, there's probably going to be some short-term displacement in the rental market, multifamily. Just because of the eviction moratorium you talked about, and some other tenant-related issues. Long-term, the demographics are really very strongly in favor of multifamily. So if you can get through the short-term issues, or if you can be on the sideline with cash when the current owners get through some short-term issues, I think the longer-term outlook is very, very strong. The industrial sector is going to be really strong because of the need for distribution and warehousing, and more cloud computing as more people work at home. The two areas I'd be looking for relative bargains and this might require you to do some adaptive reuse or reformatting of the properties, would be retail and hospitality. I think those are the two sectors that are really going to get hammered in this pandemic, and there are going to probably be some buying opportunities, but they might require, for example, turning a suburban mall into a mixed-use facility with residences, entertainment, shopping, and office spaces. So they're bigger investments and longer-term strategies, but there are definitely going to be some opportunities in the commercial sector. I think we're going to have more distress there, relatively speaking, than we have on the residential side.
Oh, 100%. I mean, the opportunity, we're gearing up for it. Back in 2010, we bought stuff that nobody else wanted. And back then it was land. Nobody wanted land. They were giving it away. We were buying land for 10 cents on the dollar, 4,200 lots in Tampa that nobody wanted, that had been 160 million in escrow in 2006, went into bankruptcy, and we bought it for 16 million. So when you can find the thing that nobody wants, and get an idea what we did with that, just to give you an idea, like Rick said, it was zoned to be a golf course property. Well, golf has gone down in popularity, and there's enough golf courses in Florida. So we kind of looked at all this land that we had acquired, and it was all zoned for golf course. Well, what else could you do with it that might be more interesting, that might set it apart? And we discovered this thing called a crystal lagoon, where they can turn it into this huge lagoon with sand, and it's like high tech. It uses a small percentage of the amount of water you'd use for a golf course, even though it's a lagoon, and people can paddleboard outside of their houses. And to be able to configure something is the exciting opportunity, just like Rick said. But that's when you got to be good at syndications and bringing in good developers for something like that,
and people to keep all the alligators out.
Well, that's true, but that's one of the things. It's crystal lagoon, so it's totally clear. You'd see them.
So you can see the alligator. Yeah, like looking at you. So
you would see it.
Because I'm very familiar. Every piece of body of water in Florida has an alligator in it. So just watch out, even your pool. No, I mean, I think there's great opportunity. Like you hear some of these, there's, on a commercial sense and a larger, commercial sense, especially some of these large buildings in some of these major markets that are empty right now, and what that might, and even like what are those things called that people stay in, hotels and resorts and so forth. Like I'm in Maui right now. I'm right in Wailea, and Wailea resorts are like 20% capacity, 30% capacity. There's like nothing there. The restaurants are closed. Like, and these are massive resorts in Wailea in Maui. But that's nationwide, right? As far as these hotels. And I think, Rick, you mentioned the other day is like 36% occupancy in hotels or something like that. So that can't not trickle down at some point into some other aspect of real estate, as these large businesses are affecting other businesses, smaller businesses that depend on those other businesses to run and be successful. And how that reflects back into real estate is more severe, I think, than people might give it credit. But that note, I think I'd rather be Luna behind you, Kathy, hiding underneath the cabinetry and just wait and see than I would today in real estate. I don't know. But I think some good opportunities in 2021. I'm not as fearful as I used to be, that's for sure. Earlier when we were on this show 6 months ago, I'm just going to hang out and see what happens. But, maybe that might not have been the best thing to do looking back, which also means we could all be completely wrong too in everything we're saying. So if you're listening to this, make your own decision. We just share our educated guesses. And as you know, the experts are always right. Always. So do the best that you can for yourself, because that's what we do as investors is we mitigate our own risks and make our own decisions as much as possible. That said, Kathy, where can people get a hold of you?
realwealthnetwork.com. I also have the Real Wealth Show podcast and Real Estate News podcast and a book called Retire Rich with Rentals on Amazon.
And Rick Sharga.
Well, please make sure to visit us at Realty Track. There's no K at the end of Realty Track. A good foreclosure site. But you can also, if you like, follow me on Twitter or reach out on LinkedIn. I'm really easy to find. It's just Rick Sharga at both places. And I'm posting information about this kind of stuff all the time. So if you're interested, feel free to reach out.
Absolutely. Get educated, people. Make the right decision for you. And we will see you on the next show. Thank you, Kathy and Rick, for joining us again. I really appreciate your time, and it's always a pleasure.
Thank you. You too. Bye-bye.